What up, everybody? This is Jeremy with Escape Velocity Trading. I wanted to give a quick little tip here on the market and how important it is to actually learn to trade effectively. So I'm going to show you a position here, share my screen, and you are going to see that I bought some stock and am able to actually profit if the stock goes up or if the stock goes down. It does not matter what direction that it actually goes. So, looking at the chart here, I bought 100 shares of SPY. Right here, you can see the order on 425. I bought at $548. So, right here. And I did that because we got a technical break of the diagonal resistance here. We had had some really big volume coming in on big green candles, and then we had broken out of this resistance level here. And I was expecting this recovery to continue because there was positive news on trade wars and tariffs and stuff starting to calm down. There was a pause announced on the tariffs that Trump has enacted in a bunch of different countries across the board. And so I was expecting the market to like that and for a rally to ensue. So bought 100 shares here. We got that big rally. So from that point coming up to the top, I was up about 9% or so. So not bad for about 15 or 16 days worth of trading. But we have started to roll over there, and today we actually gapped down slightly on news that Trump is actually ratcheting up the trade war again, and he is considering putting on a 50% tariff across the board on the European Union. So obviously, if that goes into effect, he said there was an effective date of June 1st if the trade deal with the European Union falls through. And so right now, I am expecting some volatility over the next couple of weeks here as we approach June 1st, because if that trade deal does go through and they find a happy medium and these 50% tariffs do not go into effect, this little market reaction to the downside will be overblown. Market will probably buy that and drive price back up. But if they can't come to a deal, that will go into effect on June 1st, and the market is going to frickin' hate that. So I wanted to protect the position that I just done. Some people might say, why don't you just take profit on that 9% gain or whatever it was on the stock? And the reason is I bought this 100 shares as part of a plan to start scaling into a long-term position. Now, I don't want to sell those shares as a short-term gain. I want to hold exposure to the S&P 500 for long term. This is something that I'm building for a long-term position, and I scaled in with part of the capital that I eventually want to have in the SPY. So to protect that, what I can do is go out to our options chain here. And if anyone is not familiar with options, it is a little bit more advanced trading, but once you learn the basics of it, it is pretty easy to do, in my opinion. And this is something that I do teach in coaching, and I'm also including a little bit in the Escape Velocity Trading Fast Track to Trading Success course. So if we go out to our option chain, we're going to go out to expiration date of 15 of August and then come out and you can see the position that I bought. I bought two puts at the money strike price. So paid about 20 bucks for each of those, so 40 bucks for that. Remember, you have to multiply that by 100 because these control 100 shares of stock. So it was about $4,000 to buy two of these puts. Now, if I go back out to the chart and look at this for a second, what do those two puts do? If I want to, I can go out to the Analyze tab, and if I look at just the stock, the profit and loss for the stock itself, this is my break-even price right here at 548.66. And this little yellow hash mark right here is the current profit on that stock. So right now I am up $2,900 on that position. So now I can show you the addition of buying those two puts. And what this did was basically, if I had just bought one put, to the left here, this line showing the profit and loss as price goes down. So right now, current price is 578. If the price goes down and I own that stock, If I just own the stock, I start losing that profit. And if it goes below my break-even price, I start to go into a negative. You can see the negative number right here next to my cursor increasing as we go down into the left, right? So this is my break-even price, currently up 2,900 bucks. By adding these two puts, if I added one, it would have made this line to the left of the strike price that I bought, 577 current price, just a flat line there. And because I paid $2,000 for one put, that and I'm currently up 2,900 on the actual stock, that means that the break-even price for this trade with the stock and put combined would have been $900 in gain. So I would not have been able to lose on this position. It would be impossible to actually lose on that position because if the stock goes up in price, I gain on the stock. And if the price goes down, the put will offset what I lose on the stock, and therefore I cannot actually lose. So the reason I bought two of these is because with this news, if things get resolved on the trade war, I'm expecting prices to move higher. If it doesn't, I'm expecting price to move lower. So we kind of have this scenario where price can go either direction. But my bias is that the stock price is going to move significantly one direction or the other. I don't expect the stock price to just stay in the same price zone that it is. I am expecting volatility to one side or the other. I just don't know what that volatility is going to look like because I don't have a crystal ball and I don't know if Trump is going to come to a trade deal with the EU or if the EU is going to say, F you, no, we're not interested. So to protect myself, I bought two puts. And you can see instead of being a flat line on the left here, we actually have a increasing line to the left of the chart as well. So this means that on the right, I will gain on stock if the price increases, and on the left, I will gain on the two puts if price decreases. Now you can see these two little red lines here. These are basically the break-even prices for the trade at the time of the expiration of the puts, the options that I bought. So if at August 15th price is between $589 and on the low end 565, that is the only window in price where I will lose money. And you can see down here on the left-hand side these two numbers. So if you look at the blue one, when I move my cursor over here, you can see that at the very worst case scenario, I will lose about $1,000 on this trade. And that is if price goes absolutely nowhere. But as price moves to the left or as price moves to the right, that loss decreases until I pass that break-even point, and then it turns to profit. So let's mark this on the chart really quick. We have 588 and 565. So if we go out here, and I am going to switch my drawing tool, and we're going to go 568, or no, 565 is what we said. So right there. And then on the top side, we said 589. So 589 right there. So between these two gray lines is the area that I do not want this stock to stay. If the stock stays between these two lines between now and August 15th, I will lose $1,000. But if we get good news on the trade war and the EU comes to a deal with Trump, let's say the market rallies and just loves that, and we come back up to all-time high at 613, which I think is pretty reasonable if we end up getting a trade deal announced with the EU. So at 613, we can go back to our Analyze tab here, look at our risk graph, go out to 613, and we can see that we would make about $4,000 on that. If we have a max risk of $1,000 and a possible gain going back to the all-time high here of 4,000, that is a 4x potential reward to potential risk. That is a great ratio. Now on the bottom side, let's go out and look. So if we came down to the previous lows, that would be down to 480. So if the EU ends up saying, F you, I'm not interested in a deal, I actually think coming back down to these lows would be fairly reasonable. So let's say if we come back down to 480, Let's go back out to our Analyze tab and look at the price here on the bottom. You can see the scale, 400, 500. So let's go out to 480. That would be an $8,400 gain. So again, risking $1,000 to make potentially $8,500, an 8.5x return versus risk ratio. So for anyone that is just a strict buy and hold investor, that doesn't know how to trade options, doesn't know how to participate in short-term movements and short-term trades to be able to protect your long-term investments, this is incredibly, incredibly important to know how to do. For anyone that is interested in just simply short-term or position style trading, this is also incredibly, incredibly important to do. You can see here again, if we go back to the Analyze tab and I get rid of those two puts, if we just have the stock by itself, if we came up to 613, we'd make about 6,500. Or if we came down to 480, we would lose 6,600. So instead of having 6,600 of potential risk there, we are limiting our risk to only $1,000, which is the basically same as the stock price moving down to 537, which is right here. So we are eliminating the risk from this point on all the way down to here. There is zero risk from that point all the way down. It doesn't matter if the stock just drops off a cliff. So this is just a quick tip tutorial to show you the importance of learning to trade the financial markets. If you are interested in learning to navigate the financial markets like this, if you are interested in being able to protect long-term positions or to put on short-term trades to profit from market movements and news-based events like this, hit me up. The Fast Track to Trading Success course is available, and I also offer one-on-one coaching to help you with your trading needs. So with that, I will talk to you guys later.